The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike, Chris, and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike, Chris, and Al.
And it is Saturday, and we are talking about money. So, question, who do you listen to for stock information, for stock advice? Think about this. Baseball managers, football team presidents, when they get out their checkbook, they sign a player to a huge contract, do you think they check to see what his performance was? Do you think to see what the statistics were? Do you think if they sign a prospect as a baseball player, they don't check what his average was if he was a hitter, what his earned run average was if he was a pitcher? They don't check all the rest of the performance statistics? For a football player, if a guy is a quarterback, you don't think they check to see if they complete a pass? Or a running back, if they get how many yards they gained? Don't you think they check that out? You know, the question then comes up, people with their own money, how often do you check the track records and the stories and the validity of what people say? Who do you really listen to? Who can you really trust what they say? You know, you look at brochures, you look at TV ads, you listen to CNBC, listen to The Money Show, and people always have a really, really good story. But do you think a baseball manager or a baseball team would hire a player who just had a good story? Don't you think they'd check out to see if the facts, if the real statistics weren't there, what it would be? Anyway, that's what we're going to be talking about today on About Money. I'm here with Al. Chris is gone today, but it'll be the two of us. And so let's kick it off and get started. You know, one of the people on CNBC is Jim Cramer.
We talked about him.
We did. So he's very emotional. There's no doubt that he's a type A personality. He comes out, if you ever listen to the program, and I have CNBC on all day long, so I'm listening to some of it sometimes. Although I have to admit that a lot of times I just tune that whole thing out. When you listen to what he says, have you ever heard anybody say, Jim Cramer, you recommended stock ABC to me? You recommended it at 45 and now it's down to 30? Have you ever heard anybody say that? No. It's always you recommended stock 45 and it's up to 60. Now, why do you think that is? What do you suppose goes on?
You think Jim Cramer is a Baltimore stockbroker?
I think Jim Cramer has people that listen to the call-ins, and if you have a bad story, you never make it on the air.
No.
I mean, think about it. Jim Cramer, a few years ago, 2007, came out and said Bear Stearns was a table-pounding buy at $72 a share. 2 months later, it was at $2. I mean, that provoked Jon Stewart to run a program on Jim Cramer, in which he raised those questions. But Jon Stewart wasn't the first one to do that. Barron's, in August of 2007, did a story on Cramer. They looked at his recommendations and they looked at how well those recommendations performed, and they found that he significantly underperformed the market. He significantly underperformed. He trailed the S&P 500 by 4%, 12% versus 16% over the period of time they looked at. And then CNBC's response was, Jim Cramer is there for educational purposes. Not stock picking, it's just educational. And they tried to say that he only bought things for 1 or 2 months. That's the most you could count on. Barron's checked out all of that and found all of that was false as well. And they published that. And since 2007, you'll never seen any advertising from Barron's on CNBC because they've been banned. You know, the agenda is not for Jim Cramer. The agenda is not to do stock picking. It's not to give recommendations. What's the agenda?
Advertising. Make a buck.
That's the whole.
Boy, I watched him the other day. Not because I like watching him. Actually, I don't watch him at all. But I happen to be on the Stairmaster. And what do you do with a Stairmaster? You stare. And so that was on TV. And I'm watching, like, the amount of commercials that were unbelievable.
Mm-hmm.
I mean, he generates a lot of money for them.
He does. That's why he's on the program. That's why he's there.
But we've talked about before, Mike, that prognostication is extremely hard to do. Who was it that said it? I think it was a Swedish or Scandinavian physicist. You know, making predictions about the future. Making predictions is really difficult, especially when it's about the future.
Yeah.
You know, I mean, so these guys, and I just read one before I came over here from John Hancock, their top economist, talking in July about how, you know, everything's going to slow down. We're going to see this. We're going to see that. Everything was, you know, precarious. And what we've seen since the bottom of June 20th is nothing but the market go up. We've seen inflation subside a little bit. So gas prices keep coming down.
So, I mean, predicting the future is hard, you know? One of my favorite philosophers is Yogi Berra, the former catcher of the New York Yankees. And he said, predicting is really hard, especially if it's about the future.
Yep.
And I may not have gotten the quote right, but it's that kind of thing. It is difficult. You know, Fidelity, I was at a conference and they gave out a book called The Little Book of Behavioral Investing. And the subtitle was How Not to Be Your Own Worst Enemy, written by John Monetier. And chapter 5 was on forecasting, a chapter which I read and I disagreed a lot with. But it begins with a quote from Lao Tzu, Chinese philosopher in the 6th century BC, who said, and I quote, "Those who have knowledge don't predict, and those who predict don't have knowledge." And yet that's really the business we're in.
Yeah, I mean, I go back and look at, I think I've mentioned this before, but I'm reading Howard Marks's memos, who doesn't do predictions. Is every time they put him on the show, CNBC, wherever he goes, they try to pigeonhole him to giving a prediction or a buy or a sell or rating. He says, I'm not doing it. I don't do prediction. In one of his memos here, talking about macro, which he did in 2020, how clueless the prognosticators are at trying to predict where the market was going to go. You know, he said in December of 2009, the median forecast on Wall Street held that the S&P would rise 2.7% in 2020. Since the actual return of the index was 18.4%, the forecasts were low by 16 percentage points.
Oh, think about 2008, when the forecast going into 2008 was an increase of 24%.
Right. And in 2000, they predicted that there would not be from 2000 to 2020 or 2000, I think it's 2020, they didn't predict 1 year that the Dow Jones, the markets would decline. And they had 6 declines in those years. And they, again, missed 2008, which was catastrophic.
So it's really difficult, no question about it. But we're also in the predicting business, because you don't buy a stock saying, I'm just going to take a chance and hope it goes up.
No, but there's predicting and there's, you know, we can't predict the systematic and geopolitical risk. Mm-hmm. We can't predict those things. We can't predict what China will do with Taiwan. Nobody really predicted that Russia was going to invade Ukraine this year.
Yeah.
Maybe some people did, but it wasn't widely thought that that was going to happen. We can't predict these things. Nobody predicted COVID was going to happen. I mean, it's too difficult to try to figure that out. So for what we do, it's about managing the business risk, which we think we can manage a lot of that.
So, you know, sometimes I compare it to games. If you have an expert and a novice and slot machines, the novice will do just as well as the expert. In chess, a novice and an experts always win. Mm-hmm. Always win. In poker, however, because the cards come up differently at different times, sometimes the novice comes out better than the expert, because there's a probability that's involved. And we're in the probability business. When you talk about what we're doing, it really is. We're trying to figure out what the probabilities are, and sometimes we're wrong.
Yeah, I mean, we don't have to be right all the time to make money, though. We've talked about that. We can be right three times out of 10 and still make money.
Yeah.
So we know we're going to be wrong, right? We're not going out there saying we're going to be right all the time. It would be foolhardy. Even Howard Marks will tell you, and the greatest and best is out there will tell you they're not right all the time. But the guys on the TV will tell you they're right all the time, which is ironic, right?
It is, because they're not trying to manage a portfolio. They're not trying to.
No, but who are they beholden to? Who are you and I? We're beholden to our clients. Our
Correct.
clients call us and say, hey, Al, the market's down 20%. Hey, Mike, the market's down 25%. Yeah, we know. This is what we're trying to do. This is our vision. This is what you've signed on to long term. They're beholden to advertisers and other people. Like we talked about, I relate this to what we talked about, 3 weeks ago, the mutual fund industry. Who are the mutual funds beholden to?
Yeah.
So they're beholden to the companies and their stock prices, not necessarily to the people that are the investors, right?
Correct. And we're going to come back and revisit this, so don't go away. We're coming to commercial break.
So, Mike, we talked about 3 weeks ago about the mutual funds, right? We talked about all the embedded costs, the soft dollar costs, the trading costs, the hidden costs that people don't see. The average cost of a no-load mutual fund is actually 3.17%. And what does that have to do with making predictions? It's because they make predictions, and then they got to find something that we have to do about our predictions, which is a product to buy to stay invested, right? So right now, what are the last week's article in Barron's are talking about Buffett ETFs, right?
Yes.
So I mean, I don't have any problem with Buffett ETFs, but the problem is that the issue is that, okay, it sounds great in a market that's tumultuous, right? It is right now. But when the market starts to turn and go up again, what's going to happen? Yeah, you're capped on your downside, but you're also capped in your upside, right? And people think ETFs are all inexpensive and low cost in the mutual funds, and most of them are, but there's still a lot of ETFs out there. Some of them I read that cost 3%. And they're trying to have these now managed ETFs where people actively manage in the ETF.
And people pay for that.
Yes.
There's no way that everybody does that just because they love people to make money.
Yep, exactly. But the point is that, my old manager used to say, when I was working for an insurance company which sells variable annuities, and sells life insurance and fixed annuities, right? He used to say, well, every product has its day, right? When the market's going up, you're hammering the variable annuities. When the market's going down, you're hammering the fixed annuities and the life insurance, right? But we don't do that at AFC. That's not our approach. Our approach is strictly to try to identify the companies that we believe are going to prosper over the next decade or 2 decades.
And we do. And,
yes.
You brought up annuities. Annuities set a record in the second quarter in sales, $77 billion worth of annuities. And the reason is because people get scared.
Mm-hmm. So
they buy an annuity.
Well,
so they're down 20% in their account, and they lock in their losses.
Yep. And then they have surrender charges for 7 to at least 7 years on those. So they can't get the money out. They can get maybe 10. They do allow you 10% free withdrawal, but you can't get your money out and then stick it right back in the market.
Yeah.
And the other thing is that when I worked for these companies, I know what they do. They go out and tell everybody, well, the market's not going to return 58 or 10% anymore, so you might as well just take your 2 and 3% and put your head on the pillow and not worry about losing money. And that's what they tell them. But the market does take off again.
It does.
The inertia of the market, will it be this year, next year, the year after? We don't know, right? Nobody knows. But we know that it will eventually start to precipitate up again.
Well, yeah. And if you look at the long term of the market, it starts in the lower left-hand corner and ends in the upper right-hand corner.
Yeah, and we talked about this last week, but we were talking about the inflation and inflation problems. And we said, if you listen to, and you want to go back and listen to last week's, listen to it, because there's a theme and a correlation between the mutual funds, what we talked about last week, and what we're talking about now is that we've seen these times before. We talked about after World War II and World War I, there were inflationary times. After the Civil War, there was terrible inflation problems. And so we've ridden these before.
We have. And eventually, the government works through and takes actions which reduces the inflation. And sometimes there's suffering that goes along with that.
Yeah, and we don't know how, right? We've talked about, quantitative easing. Now we're talking about quantitative tightening. So when they unwind that balance sheet starting in September, we really don't know what's going to happen. That's one I would say, large matzo ball out there that we don't know what's going to happen.
But we have some ideas of what might happen. And that's That's assigning probabilities and looking at it.
Yeah. We know that. I mean, if they're going to be tightening the money supply, that's something. I mean, how is it going to affect the unemployment rate, which is historically low? And we talk about predictions, right? What did they predict for the job numbers in July? 258,000. They saw over 500,000. It just goes to show you how way off these people are. They don't really have a grasp of what they think they know. And it goes back to what Howard Marks says in one of his quotes from Mark Twain is, it's not what you don't know that gets you into trouble. It's what you think you know that just ain't so.
Just
I mean,
that's true.
But it's those nuanced things that you just don't see, and you can't quantify in some large algorithm that's going to throw you a curveball that you're not going to see it.
But coming back to who you listen to and who do you trust, there's probably the biggest expert on forecasting is a guy by the name of Philip Tetlock. He did his PhD thesis in 1987 on forecasting things in the economy worldwide, predicting what was going to happen to the Soviet Union, predicting whether Quebec was going to secede from Canada, predicting all these things in the economy. And he wrote a book called The Expert Political Judgment, in which he said some experts were grossly overconfident. 15% of the events that said had no chance of ever happening, 15% did happen. 25% they said were table pounding things, table pounding buys, table pounding events. You couldn't go wrong. 25% failed. He said they had an 80% confidence in their predictions, but only 45% were right.
Right.
And what he said is he divides the world into two types of people, hedgehogs and foxes.
Right.
Hedgehogs are type A personalities. They have big ideas. They have large following. Foxes have a plethora of small ideas and a multitude of approaches. And he said, the fact is some experts are better than others, but the losing side is the experts whose opinions are most often cited in media. And when they're not right, the response is, well, if only the Fed had raised rates, or if only the Fed had lowered rates, or if only this had happened, if only that had happened. Or ceteris paribus, which means something outside the model happened. Russia invaded the Ukraine.
Right.
We had a nuclear disaster. Or we almost got it right. They almost got a home run.
Well, you hear all these, you see commercials from, I think it's IBM, that talks about their predictive analytics, right? They have all these, and what they're trying to do is not just predict world outcomes, like, what's his name does in his, Ray Dalio does in his book. He just looks back at history and tries to predict where things are going. He's done a good job, but he's had some tough years investing, but they're trying to predict human behavior, which is extremely difficult to do. I think it's, Eamon Tversky, who's a clinical psychologist, mathematician, he says, it's frightening to think that you might know something, but more frightening to think that, by and large, the world is run by people who have faith they know exactly what's going on. And they don't.
No.
They don't. You can't predict. Human behavior is extremely difficult to predict.
And that's why the stock market's so difficult. You have millions of people with all sorts of different opinions, making all sorts of different decisions, and trying to predict that is extremely difficult.
Yeah, I read two stories the other day from two economists, right? One from she worked for the department, that department of, what do they call the Realtors Association? I can't think of the association, but she was predicting that real estate would do fine, that, we're not going to have a problem. We might see a little decline, but it'll just keep going. And then there was an economist who's with Custodian Interactive Broker who predicted, no, real estate's going way down the toilet. So, I mean, how do two people take the same numbers, right, and come up with two drastically different opinions? If you can answer that question, we'll just end the show right now.
So I have to reflect back on what Harry Truman said. He really would like economists with one hand.
One-handed economist. Yeah.
Because they usually couch their opinions on the other hand.
Well, the first Nobel Prize for economics was in 1969.
Yeah.
Okay. In 1895, when Albert Nobel endowed this, to physics, chemistry, and a couple other disciplines, economics wasn't there. And it wasn't until the Sverige Risk Bank decided they were trying to break away from the government controls of Sweden, so they needed, well, how do we do this? So they donated some money and said, can we have this prize in his name? And if you look at all the winners, they were all people who were classical, neoclassical economics, saying, okay, the market-driven forces to drive, that was their goal, to drive themselves away from that bank. But it wasn't until when, what was his name? The economist who won in 1974.
Markowitz?
No, it was, Friedrich von Hayek. Von Hayek said, he got up there and he lambasted the committee in 74. He said, nobody should be bestowed with this prize because it puts too much emphasis and creates economics as a hard science like chemistry or physics. Every time we throw the ball up in the air, we know it's coming down. But economics, we don't know. And so people like laymen and politicians and TV people will take advantage of those and use them for themselves. That's basically what he said in a nutshell.
Yeah. No, economics is not a hard science because you're dealing with human emotions and you're dealing with millions of people making millions of decisions based on incomplete information.
NPR is a show on Saturday by Dubner, those guys called Freakonomics. If you read their book,
Yeah.
And things change in economics, right? People say, not like science doesn't change, right? Math doesn't change. Photosynthesis is not going to change, right? But let's look at the Phillips curve, Mike. Has the Phillips curve been relevant for the last 20 years?
Yeah.
If you don't know what the Phillips curve is, it's a curve that was derived for the relationship between inflation and unemployment. For every 1% uptick in inflation to be a 1% uptick in unemployment. We've had very low inflation, very low unemployment. The Phillips curves basically throw it out the window. It's useless.
Yeah. We're coming to a commercial break. Don't go away. We're going to continue this. Who do you trust? Who do you listen to? And don't get us wrong. It almost sounds as if we started this by saying there's nobody to listen to. But we'll come back, and we've got some suggestions on how to listen to people.
Yep.
And who to listen to. So don't go away. We've got more to say. So, Al, you mentioned the jobs numbers that came out. Yep. 258,000.
Versus 528 or over 500,000. Let's just say that was.
But one of my favorite people.
Little rounding error, Mike.
One of my favorite people, because he almost always gets it wrong, is Larry Kudlow.
That's why you like listening to him, because he gets it wrong so much. He just make predictions on what is Larry saying. I'm going to do the opposite. Okay.
Well, maybe it's because I think I'm more right than he is. But he came out and said, before the numbers were announced, he said he would be surprised if it was 100,000. He thought it was going to be significantly below 100,000. Completely surprised. But he's also the economist who, during the Bush tax cuts, said that the tax cuts were working. They were continuing to work. And as we approached 2007, 2008, he said, no, we're not in a recession. We're going to enter the 7th year of the Bush boom. And he didn't budge. He said we're in a mental recession, not an actual recession.
And that was that 2006 he said that?
2008.
2008 he said that.
It was finally, when Lehman Brothers went down, that he finally changed his mind.
Yeah, and about a year before that, it was Greenspan saying there's no froth in the housing market either.
Yeah.
So
I mean, he's a classic person who said it just hasn't happened yet. He's still predicting that the economy is the product of the 2017 tax cut. He said, it's illusionary that we ran up big deficits because of the tax cut. Because, tax cuts always stimulate the economy and always pay for themselves. That's a philosophy. That goes back to the Laffer curve. I mean, the Laffer curve is the upside down U.
Mm-hmm.
That on one side, if there's no taxes, there's no revenue to the government. On the other side, if there's 100% tax rate, there's no revenue to the government because nobody's going to work for free.
For free, yeah, yeah.
So if you're on the side of the U where it's coming down, it has one effect on stimulating the economy. So lowering the taxes, actually, on the downside of the U, will actually result in deficits. If you're on the upside of the U, by raising taxes, it increases the money coming into the government. You can look back to the Kennedy years, and we were on the left side of the U. So when they did the tax cut, it raised income to the government. In the Clinton years, when they raised taxes, it increased revenues to the government. In the Bush years, when they lowered taxes, it increased the deficit. In the Trump years, when they lowered taxes, it increased the deficit. So it's understanding that it's not always going to result in increased revenues to the government, understanding that sometimes it's going to result in deficits, but hanging on to the idea that just lowering taxes is going to be a positive.
No, done strategically, it can work, right? But just lowering for the sake of saying, politicians want to do something, want to lower taxes, not necessarily going to work.
And you have to say something about politicians during this whole thing. Most politicians are not economists. They're not experts on foreign policy. They're not experts in healthcare. They're not experts in infrastructure. So they're dealing with all these things, and they're listening to experts around them.
Mm-hmm.
And if the advice they're getting is wrong, they come up with the wrong answers.
Mm-hmm.
So you can't just blame the politicians and say they make the wrong decisions.
No. I was just looking at, another economist, Peter Schiff. He's chief economist, global strategist at Euro Pacific Capital. And he's predicting that inflation continues. The U.S. is headed towards massive economic crash. And this is after inflation started ticking down and, things started settling out, and he's still predicting massive economic crash.
Yeah. And my guess has been for a number of years that the secular bull market will come to an end with high inflation. I believe that's the highest probability, but we're not there yet.
No.
Inflation doesn't pick up in a big rush because it's like the frog sitting in the water.
Yep.
Drop it into boiling water and the frog jumps out. Heat the water slowly and the frog eventually dies.
The funny thing is, the more I read about inflation, the more I understand that they really don't understand it, in a sense. They really don't have a huge grasp on how it takes off and how it they know, right? Okay, spending too much money in the economy, right? Too much money chasing too many goods. We know these simple phrases that we utter, but they really don't have a grasp of how it stays around and how it just precipitates like it did in the 70s. They really don't know.
No, but we've been through it before. We know some of the things you can do to arrest the inflation.
Mm-hmm.
And the Fed is doing some of those things.
Yeah, we agree. We agree on that. Yeah.
But it's back to this question: who do you trust? Who do you listen to? I think it begins with understanding what the agenda is.
Yeah, I had a guy I've been working with, and he's in Wyoming, and I've known him for a long time. He called me the day, and we started talking, and he's telling me what he's listening to, and I just had to dispel it and say, well, that's really not true. This is what's really happening. And he kind of, you set me at ease, because what he was listening to was just scaring him to death, that the economy's going to the toilet and everything's going to go down. And I said, no, this is probably what's most likely to happen. And he felt a lot better that, instead of listening to some talking heads about what they were saying, he gets something that, and I'm not saying I have all the answers, I don't, but we got to take a lot of this with a grain of salt, what we hear on the TV, read in the newspapers.
Well, and negativity sells.
It does.
There's no question.
It does. I did it just for this show, right? I did a Google search on, will the stock market or will the economy crash in 2020? Oh, man, you just get, right? Do the opposite. Try a positive one. How much will the stock market rise? How much will the economy increase? You'll get very little information. You'll get a little bit of data from a couple places, but you don't get nearly the plethora of sites that have these, crashes, and the first one that comes up is Harry S. Dent. He's actually a smart guy. He's got some good insight. He really does. I did read one of his books, The Demographic Cliff. It's got some good information, but it's a lousy read. But he's always predicting that everything's going to go to him and that other guy. What's his name? Rich Dad, Poor Dad, Robert Kiyosaki. They're always predicting everything's going to go down to nothing. And we're going to be carrying sticks and living in caves again.
But remember, Harry Dent started with Dow 36,000.
Yeah.
And he's right. We're close to 36,000.
Yeah.
He just predicted it by the year 2000. He was just off by 22 years.
23 years? Another rounding error.
I mean,
he has been right, though, Mike, on the demographics, right? I believe this because I've been reading a lot about it. And I read a paper written by the Philadelphia Fed on this, is that we are in like a long, prolonged GDP slowdown because of the aging population and people aging out of the workforce, and we don't have enough people coming behind them, and that's going to limit productivity. So like Howard Marks mentioned in a video I watched the other day, that he thinks we're addicted to cheap money right now because, we've been doing it for the last 20 years. We're not going to go back to normal historical interest rates. But because of that protracted decline in the people entering the workforce, the Fed's putting that money into the economy does stimulate some growth, but we can't keep doing that. Not going to go forever.
No, and the Fed is actually taking money out of the economy.
You're doing it right now. Right. But we don't think, but people like Marx and a couple don't think that's going to last very long.
I think it may last longer. It depends upon how well the economy does.
Yeah.
Right now, with 3.5% unemployment, and the demographic argument, I've heard that before too.
Yeah.
But productivity doesn't depend upon the number of people. Productivity depends upon automation, depends upon a whole lot of other things.
It does. But they thought they would see, this article I read, thought that they would see that with the internet. They thought, oh, this is going to be a huge productivity, but it didn't happen. It didn't materialize. And so what they think, and because of automation, all these things, that we will have companies that are more productive, but they look at productivity per hour of, human labor, and that's what they're looking at. And it's different. So unless we're all going to be sitting around and not working, I don't know.
If you look back in the middle of the 1800s, we had 23 million people living in the United States, 11 million on the farm.
Mm-hmm.
And you had people like some economists predicting that we'd reach the maximum of our Malthus preached that we'd reach the maximum of our productivity on the farm.
Yep.
Today we have less than 1 million people working on the farm, and we produce almost 1,000 times what we produced with 11 million.
Yeah, Malthus missed that we would increase yields of crops.
Well, yields of crops, we have tractors, we have trucks, we have refrigeration. We have so many more things.
Yeah.
That's all productivity.
Right.
If you look at manufacturing, you can say the same thing.
Mm-hmm. Mm-hmm.
So productivity is one of those strange things. If you look at electricity, we had AC current that came at the beginning of the 20th century. But it took 40 or 50 years to realize the full benefit and to have everybody.
But what AC currency precipitated, right?
Yeah.
It precipitated the factory, which precipitated the start of the automobile industry, right?
Yeah.
But that all sort of happened at the same time, which massive productivity. But when the internet came about, they thought they would see something similar, but it didn't materialize.
Wow.
So
we're yet at the beginning.
We'll see what happens.
So we've been talking about, who do you trust? Who do you listen to? I know for myself, I go to a number of conferences and I listen to speakers. I take notes, actually. I write them down. I keep them in the computer. And before I go back to that same conference, I review the notes to see what people have said. And then I judge the people based on what they said before, and judge them on, people always get things wrong. I get things wrong. Al gets things wrong.
I don't get
It's not being 100% right, but it's the general information, and it's not only being general, it's admitting when you're wrong. One of the biggest problems is the person who never comes back to the fact, I was wrong last year when I said this.
Yep. It's like I watched, if you watch ESPN, there's a guy in there by the name of Max Kellerman. Since 2015, he's been predicting that Tom Brady's going to fall off the cliff. He's only won 3 Super Bowls, been in the playoff every year, and he's 45 years old. And they say he looks as good as ever. So,
But someday he's going to be right.
he's going to be right. Yeah, absolutely.
You know, I say I can predict the weather 100% with accuracy, and I've never been wrong. I can tell you today when it's sunny outside that it's going to rain. I can tell you it's going to snow. I just can't tell you when. It reminds me of the old joke that was going around. An old airline, Northwest Orient, was always late, and they said they figured out the way to always be right on their arrival times. They were just going to say the day they arrived, not the time they arrived.
That's a great business model. Who thought up that one? So who do you listen to, Mike? I mean, where do you go find your news? I mean, if you want to dig in deep on something, you know, where do you go? Who's
I
trusted?
listen to a lot of people. You know, I make fun of Kramer and Kudlow, but
Yeah.
I listen to what they have to say.
Yeah, I do too. But I mean, who do you really go to? I mean, I listen to the TV. I read Barron's. I'll read a couple other periodicals. But like, where do I go when I really want to distill it down and kind of?
I read The Economist. I read several books,
Yeah.
and I think about it. I need an hour a day of think time.
Yeah, I mean, that's a good point, because don't throw away your own perspective, because I think our perspective is as good as anybody else's perspective. They're not getting anything more than we're getting. You know, they might have a few more high level names they can call for information, like, you know, when you got 150 billion under management, but still.
And I have to think, why was I wrong?
Yeah.
When
Yeah.
you know, almost every year I predicted what I thought the year was going to be right. And I can remember 2010, I thought there was nothing on the horizon. There were no clouds for 2011. Everything looked so good.
Right.
Never could I have ever forecast Fukushima.
Right.
I mean, that happened, and
I
that
know.
had a dramatic impact on what went on.
And still having an impact in some areas, you know?
So in that case, I could say, okay, I was wrong because I never foresaw that. There was no way to see a tsunami that would cause a nuclear meltdown. But there are other times when I think things are going to happen and they don't happen. This year has been one of those times. I did not think we were going to have the downturn we've seen. Not that I thought that we couldn't have some kind of a downturn, but not to the extent we've seen. And it's a matter of reasoning it through and saying, okay, what actually has happened? And what did I not see? Why didn't I see that? You know, and there's some things you just say, I didn't see.
Right.
I was wrong.
Yeah, and it's tough because, you know, we all get hardened in our perspective and try to you know, I walked by, you know, that event we were at last night. I walked by some people, and at the end, after we left, I think it was on my way out, and they were having a debate about objective truth. I didn't jump in. I kept going. But so, you know, trying to be objective, right? Take the horse blinders off and take your whatever bent you have and try to objectively look at something and say, you know, am I seeing what I'm really seeing? It's difficult to do.
So I live in West Seattle. And the West Seattle Bridge has been out for a long time.
Yes, it has.
And there was a big article in the Seattle Times which talked about it being restarted, but it never really talked about why it failed. And before it failed, there were people that said this is the reason it's failing because bearings were not replaced that should have been replaced. Buses were going across the bridge. The bridge was never designed for a bridge,
Well,
a bus.
it was my buddy's an architect, and we talked about this, and he said that the reason why is they sent the buses over the edges of the bridge. The bridge was designed for the buses supposedly go in the middle of the bridge where the strongest support was. And they didn't want to do that, so they sent them on the sides, and that's why those
The buses
failed.
Buses were to use the lower bridge.
Were they okay?
Because buses, the impact of a bus is the same impact as 40,000 cars. The impact of a truck is 40,000 cars. So the underbridge was designed for the buses to go under there You know, and one thing that's happened is because of newspapers being reduced so much and the number of reporters that have been reduced, is instead of having investigative reporters on the newspaper, now you have people that are simply doing a couple interviews and they really don't get to the really deep facts.
No.
And I think that contributes to a lot of what's going on today, is we're not getting to some of the facts. Why did it fail?
Right.
No discussion as to why.
Right.
Just it failed.
Right.
It was supposed to last 75 years and it lasted 25 or 35 or whatever it was. And I use that example, but there's any number of things where we live today. The same thing is happening. We're not getting to the whys and the complete understanding. And so I think it's important for us when we're managing money to ask the why questions and to get to a real response, to understand.
Yeah, because some of the questions we're asking, there really isn't an answer. I mean, there is a right answer, but as you said, we don't know when that right answer is going to come, right? If we're talking about when the market's going to go up, when it's going to go down, nobody really can answer that with a high probability.
And it's important not only when things don't work, it's also important to know why things do work.
Right.
Because those are the ones you want to repeat. You want to avoid the things that don't work.
Yep.
And you want to repeat those that do work. And I think that takes thinking time.
It does.
It really is. I need an hour a day just to think about what's going on. And then I really need to work hard because I need to get 8 or 9 hours crammed into 6 or whatever it happens.
Yeah, but is nobody you really go to listen to that you like, that you...
There's dozens of people that I listen to.
Yeah, yeah.
And I read a huge amount of material.
Yeah. I think that's the key. I think reading as much as you can, taking on this, every side, and trying to distill it down yourself is. I mean, I do enjoy listening to. I don't say I rely on him, but our thinking is alike. I think, and when I listen to Howard Marks's memos and stuff, he's very pragmatic.
Yeah.
And simplifies things, and as I said, doesn't give predictions. So I don't say I rely on it, but I do like listening to his stuff, and then. You know, just as you said, reading a ton of stuff. I think it was John Neff, famed investor of the Windsor Fund. He said he used to lock himself in his office every Saturday at 1 o'clock and read all the week's past Wall Street journals. So
indeed. So anyway, I hope the program's been enlightening. Who do you listen to? Who do you trust? It's your money.
Yeah, and
don't be like a baseball manager that doesn't check the statistics of the prospects. So anyway, that wraps up today. Have a very good weekend, a very good week. Next week, we're going to talk about a different subject. We're going to talk about this winter.
About money with your AFC team, Mike, Chris, and Al on AM 1300, The Answer. For more information, click on Adams Financial Concepts.